single downgrade just shook the world's financial backbone. Moody's cut the US's last cheap-tight A rating, and global markets may already be reacting in ways Washington didn't expect. Days later, Hong Kong's $166 billion pension fund may be legally forced to dump billions in US Treasuries. Meanwhile, China's battery giant blacklisted by the Pentagon raised $5.3 billion in a blockbuster IPO. And investors piled in. Wall Street is wobbling, Beijing is building an escape hatch, and global capital is quietly choosing sides. This isn't a trade war, it's a credibility collapse. And the first to fall might be the safest asset on Earth. In a single downgrade, the US may have lit the fuse on a $63 billion sell-off without a single missile fired, after Moody's stripped the US of its final AAA rating on May 17th. Hong Kong's mandatory provident fund system, a $166 billion cornerstone of Asia's financial infrastructure, may now be legally compelled to dump a portion of its US Treasury holdings. The HK $484 billion in bond and mixed asset funds affected isn't theoretical. These investment mandates require Lobo A ratings from approved agencies, and now only Japan's R&I remains. If that final pillar falls, Hong Kong could become ground zero for forced divestment. Bloomberg reports that U.S. debt already makes up just 2.3% of the city's treasury market exposure. But this isn't about volume, it's about precedent. For the first time in history, the world's reserve currency may be deemed legally unworthy by its own financiers. But this isn't the only move China is making, because while U.S. debt is shedding credibility, China is quietly redirecting capital through something far more aggressive. CTL, China's EV battery giant, blacklisted by the Pentagon, just raised $5.3 billion in Hong Kong's largest IPO of 2025, surpassing expectations by 10% despite U.S. sanctions. On day one, the stock jumped 16%, drawing global capital into a Chinese market that Washington tried to isolate. The Wall Street Journal reports that CATL supplies 38% of the world's EV batteries, serving clients like Tesla, Mercedes, and Ford. And that dominance is converting geopolitical pressure into investor enthusiasm. In a world where every dollar matters, everyone that goes to CATL doesn't go to U.S. Treasuries. Capital flows are not symbolic, they're directional. China's success with IPOs like this signals a deliberate pivot lure investors, not with ideology, but performance. And as Reuters notes, China's industrial base is powering financial momentum in reverse, where markets don't lead the economy, but follow it. But this isn't just about batteries. It's about where the next trillion in global capital will go, and the next move China is preparing will make it even harder for the U.S. to compete. In the Treasury market, the most watched financial arena on Earth, bondholders are beginning to hedge their bets. And they're doing it with duration. According to the Financial Times, the average maturity of U.S. debt held by investors has dropped below 6 years, one of the shortest durations among G7 nations. This signals rising distrust in America's fiscal trajectory. Bloomberg data shows that U.S. 30-year bond yields are hovering around 4.97%, the highest sustained levels since 2007, suggesting investors demand a premium to hold long-dated debt amid fears of inflation deficits and political dysfunction. Wall Street analysts attribute this to term premium expansion, a polite phrase for, "We don't trust you to pay without printing." Ray Dalio warned in a recent LinkedIn post that credit ratings understate the true risk that inflation, not default, will erode bondholder wealth. And with the U.S. Treasury planning to issue $2.5 trillion in new bonds this year alone, the market is signaling we'll fund you for a price. But what happens when even that price becomes too steep? China's next move may push that line faster than Washington expects. After Moody's downgraded the U.S. credit rating, Hong Kong's mandatory provident fund, which oversees $1.3 trillion Hong Kong dollars, or around $166 billion U.S. dollars, may be legally compelled to liquidate billions in U.S. Treasuries due to strict rules requiring true QAA-rated debt. As Bloomberg reports, MPF funds are capped at 10% exposure unless all ratings agencies classify the debt as top tier, leaving only Japan's R&I holding the line. If that rating slips roughly $63 billion, it could be dumped into the open market, triggering a chain reaction. The Hong Kong Investment Funds Association has urged regulators to relax these mandates, but so far, no exemption has been granted. JP Morgan analysts warn that even a modest 3% sell-off across foreign funds equal to about $228 billion could push long-term Treasury yields up by 50 basis points. This isn't just a regulatory quirk, it's a structural vulnerability. And if other sovereign funds adopt similar thresholds, the next bond exodus may not be limited to Asia. President Trump's renewed trade war is squeezing the same system that once recycled global dollars into U.S. treasuries, and it's breaking the loop. According to the IMF, dollar reserves among global central banks have fallen from 71% in 2000 to 58.4% in 2024, and trade-linked dollar flows are a key reason. Trump's tariffs are slashing imports, which in turn limits foreign exporters' access to dollars they previously used to purchase U.S. debt. Simultaneously, the administration's proposed tax bill, marketed as deficit neutral, has been estimated by Yale's budget lab to add between $3.4 trillion and $5 trillion to the national debt over the next decade, depending on whether expiring tax cuts are extended. The contradiction is striking: cutting revenue, adding tariffs, and expecting more bond buyers. The Committee for a Responsible Federal Budget warns that debt service costs could rise above 4% of GDP, up from 3.1% in 2023 and just 1.5% in 2021. Meanwhile, Treasury Secretary Besson publicly insisted the bill would save $1.6 trillion a claim, directly contradicted by the Congressional Budget Office. But the bond market isn't waiting for resolution. It's pricing in chaos. In China, it's already capitalizing on it. While U.S. bond investors now demand 4.97% yields on 30-year treasuries, the highest since 2007, Chinese equities are quietly becoming a magnet for global capital. According to Bloomberg, the Hang Seng Tech Index is up 22% year to date, buoyed by record low borrowing costs in Hong Kong, where margin loan rates sit near 0.5%. This has given institutional investors a near risk-free lever to chase equity gains, especially in sectors like EV batteries and green tech. Companies like CL Post IPO have seen volume surges that outpace anything listed on the NYSE this year. Goldman Sachs recently noted in a May 2025 report that foreign fund inflows into Chinese exchanges hit a quarterly high of $47 billion, more than double last year's Q1 figure. What's driving this shift isn't ideology, it's capital efficiency. In the US, policy volatility and downgraded debt have driven up risk premiums. In China, financial infrastructure is aligning directly with industrial output, turning factories into fund generators. But this alignment isn't accidental. It's part of a broader strategy Beijing is quietly scaling. And if the next move lands, Wall Street may not be the global capital's preferred zip code anymore. The deficit isn't the detonator, it's the math that makes it uncontainable. According to the Committee for a Responsible Federal Budget U.S. Debt Service, costs will hit $1.9 trillion annually by 2030 if current policies hold surpassing defense and Medicare combined. This is fueled by what the Yale Budget Lab calls a fiscal mirage policies that front-load tax cuts and backload spending reductions to claim savings that don't materialize. The May 2025 version of Trump's tax plan, as modeled by the CBO, adds $3.4 trillion to the deficit if cuts expire in 2029, and $5 trillion if extended, which House Republicans are already pushing. Meanwhile, the Treasury's own data shows net interest payments hit $970 billion in 2024, up from $660 billion the year prior, a 47% spike. That's not cyclical, it's structural. Former Treasury official Mark Sobel warned in a Reuters op-ed this month. The U.S. is financing growth with a time bomb, not a safety net, and markets are responding accordingly. Investors aren't rejecting America, they're repricing it. So when credibility becomes negotiable, so does your reserve status. While Washington deflects with slogans, Beijing is laying rails financial ones. China's blueprint is rooted in a feedback loop. Real industrial output drives investment returns, which then finance the next wave of expansion. This isn't theory, it's market behavior. In Q1 2025, China's total social financing reached 14.5 trillion yuan, or 2.03 trillion US, up 9.6% year over year, according to the People's Bank of China. At the same time, Hong Kong's IPO pipeline grew by 38% quarter on quarter, per HSBC Global Research, driven by green energy semiconductors and logistics sectors directly subsidized by Beijing's 2024 stimulus package. Meanwhile, U.S. markets are tangled in fiscal gridlock and downgraded credit triggering spikes in term premiums and investor caution. In contrast, China is presenting capital markets as extensions of state-led stability, not volatility. Bridgewater Associates noted last month that China's markets are now being rewarded for predictability, something the U.S. used to monopolize. If this pattern holds the global capital flow, it may not just rebalance, it could redefine leadership. But the next litmus test is already brewing in Asia's second largest fund market, and it's aimed straight at Treasuries. When Moody's cut the U.S. credit rating last week, it didn't just bruise Washington's ego, it triggered a clause. Under Hong Kong's mandatory provident fund rules, funds are capped at a 10% allocation to non-LAA sovereign debt. With Fitch and Moody's both downgrading only Japan's R&I still classifies U.S. Treasuries as top tier. If that changes, nearly $63 billion could be forcibly sold. The Hong Kong Investment Funds Association confirmed it raised concerns with regulators. But as of now, no exemptions have been approved. That legal rigidity has global watchers worried. As Bloomberg noted on May 20th, no other pension fund system of this scale operates under ratings-dependent threshold this strict. But what if others follow suit? A similar shift in Singapore or Norway's sovereign wealth rules could unleash a second wave of sales. As of 2024, foreign holders own $7.6 trillion in U.S. debt. A mere 3% shift, just $228 billion, would be enough to push yields another 40 to 50 basis points higher, according to JP Morgan's fixed income model. That's the cost of credibility loss. And what happens next may depend less on what the Fed does and more on how much longer foreign funds are willing to play by rules Washington keeps rewriting. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.